Hi, everyone. We're here at Finance Magnets London Summit 2023. I'm joined now by Lochlan White, who's Chief Commercial Officer EMEA at 26 Degrees, and James Meek, who's Director of Prime Services at 26 Degrees. Gentlemen, welcome. Thanks for taking the time to join us.
Thank you very much.
Thank you for having us. Great.
Always a pleasure. Always a pleasure. I wanted to ask, this year we've seen a decline in general market volatility compared to the last 2, 3 years, I would say. For brokers who are perhaps having difficulty monetizing client flow during these periods of market inactivity, what strategies do you think could assist them in improving these types of metrics?
Yeah, look, it's been an interesting year where, a lot of brokers have been, asking us how everyone else is going, which is generally not the sort of question that gives us a lot of confidence that they're necessarily doing well. But it's no secret it's been a tricky year. I think we've been quite fortunate where what it's meant for the market and for prime brokers is that they've picked up quite a lot more volume throughout the year. Naturally, they're trying to hedge quite a bit more and try to reduce their revenue volatility. And what that means is the percentage of externalization to primes or other liquidity providers or even tier one bank prime brokers has dramatically increased. And what that ultimately means is there's less of a focus on internalization and more of a focus on cost reduction. So what what these retail brokers are ultimately looking for is the best possible, most stable price at the best spread, the lowest commissions, the most competitive swaps, and all around the lowest cost liquidity solution. And that's what I think that we offer. There's many other great primes and liquidity providers here in this room today. But I think the difference that we have alongside quite a few others is we're a true prime. So we have 5 prime broker relationships, tier 1 prime broker bank relationships. And there's a fragmentation of that liquidity market where there is sub-prime of prime as it's been termed, beneath the true prime level. And obviously, the closer you are to the top of the ladder, generally the better price you're going to get. The lower cost. And I think that's one of the main things that a lot of retail brokers have been looking for this year. We have had a massive influx of interest.
Great.
Yeah, I think as Lochlan said, as the volatility's subsided a little bit, we see brokers moving away from the B-book model towards the A-book model more. What that sort of means, I guess, for retail brokers is they're picking up on these key statistics like execution, which was not maybe as important to them when they were running a 95%, 90% internalization model. Now that they're A-booking more, they're starting to look at the execution again. They're looking at obviously the type of book, all of the usual stuff, but also like liquidity management. So how do you allocate your different tags to different LPs, and how does that liquidity mix interact with the flow? Which is, not something that was a concentration for them when they were B-booking so much. So as we move to this A-book model, we try to hone in on those new statistics, I guess, the execution statistics, the liquidity management, things that weren't so important before, but now are becoming more and more important. And brokers, I guess, in the last few years, it's been so volatile with COVID and the oil before that. It's been a period where brokers have moved away from the A-book model so much that they've almost forgotten how to monetize an A-book model. So I guess part of this year, and as Lochlan said, a lot of brokers came to us saying, how's everybody else doing? Do we need to change something? What can we change? Part of it was us re-educating brokers on how to monetize that A-book model again, and what are the key statistics? How do you do the data management correctly to monetize that model?
Can I just jump in on that? I think that's a really great point, James, in terms of execution. It's not that a lot of brokers didn't necessarily look into their execution in the past. It's just that they didn't have the tools or necessarily the technology to be able to analyze it as quickly as they previously did. And you're absolutely right, James. It's always been a key focus for us, and it's almost like the lack of volatility this year has meant that retail brokers are finally realizing, retail brokers are finally realizing just how competitive we are and how good we can be on the execution side of things. We're big proponents of best execution. So it's quite refreshing to see people focusing more on execution than necessarily spreads, for example, which is great.
Yeah, I think you guys bring up a lot of very important points. I've initially heard these comments with respect to, hey, everybody's been booking for so long. Even back in, I think in Bangkok, where I was with James Alexander, and I've spoken to other market participants. People have seen sort of this coming, and it's great that you guys have taken somewhat of a proactive approach and are sort of educating your customers on how to really deal with the near future in these challenging times, so to say. James, you mentioned data and things like that. I want to throw the next question to you. There are obviously many data points that retail brokers need to take into consideration when selecting their panel of liquidity providers. And as a leading FX and CFD prime broker, I'm interested in understanding what data points do you consider the most important for brokers? How do brokers get access to crucial data? And what can having access to this data really do for a broker today?
Sure. Yeah, it's a great question. I mean, data is one of those things that's just growing and growing, and there's more you can do with it every day, every week. We're trying to develop that on our side. Retail brokers are doing the same. The difference between working with a retail broker and there are many of them out there, that make decisions on gut feel rather than analyzing solid, hard data is complete different experience. And the ability that we have to optimize their liquidity is a completely different experience. So, take two brokers that had the same volume, the same client base, the same geographical aim, but take one that has a really solid data system, either in-house or a partner, versus one that's just, eyeballing top of book spreads, or every now and then taking a look at execution and then basing their decisions off that. Those two experiences are completely different. And obviously, I'm going to say that the one that looks at the data is the one that we prefer to work with. So in essence, getting access to those data points is crucial. The next thing I would say there is it's super important for those people, the broker, then to also be able to present the data internally and externally. So internally, I mean, if you're a retail broker, if you're a head of dealing, you need to be able to easily present the data to your management upstream so you can quickly make the right decisions. You also need to present the data to your team so that they can work well with the liquidity that they're then selling onto their retail clients. It also means that you need to present the data to us as a liquidity provider. So if you're a retail broker, you need to be able to easily present data to us so that we can action and make action as soon as possible.
Hold your LPs accountable.
Exactly.
We love it. I mean, whenever a client of ours comes to us raising anything, whether it's positive or negative, we're very happy because we're always striving to improve. And if they're holding us accountable, they're holding everyone else accountable. And that's the most important thing. All we ask for, all we strive for is a fair, competitive environment where these data points, specifically I like to focus on execution, are focused on. And I think one of the really cool things that has happened over the last couple of years is that these, let's say bridge providers, but it's much more than that now, have expanded into other services such as post-trade execution analysis. And that's what gets us really excited. We have our own in-house tools. We also, we do purchase other tools ourselves. But it should be something that every single retail broker focuses on because, yes, you might be paying X amount per month on a retainer for that subscription, but you'll be making 10 times more by holding your LPs accountable and by making those improvements that you get off the back of the data.
Agreed. I think it's great that, again, you guys ask for feedback, you get feedback rather than, I mean, if I think about it in layman's terms, it's a very rudimentary and cut and dry business in a sense, right? You give me prices, I execute on them. If everything's working, okay, great, thanks, right? I mean, ultimately, you really need to interact, to correspond with each other, and really find out what exactly is going on.
100%.
Yeah, absolutely. Oh, sorry.
I was going to say, yeah, I think the most important thing is getting access either through a data partner, like you said, like a tech partner, or if you have an in-house team, obviously that's can be super expensive, can be very resource heavy if you want to develop your own in-house tech, which is what we've done. It's a combination of the two, really. Having in-house tech, having a good data partner, somebody that you trust, somebody that you might pay a lot of money to, but in the end, that's going to become, the greatest return to your business is knowing where to make the right decisions, because without it, you really can't make the right decisions.
Absolutely. Time has been flying. It's been nearly 6 months already since you guys have rebranded from Invest Global to 26 Degrees. I gotta say, I really like the Invest Global name as well. 26 Degrees is awesome. It's got a lot of character and history to it as well. I wanted to ask, how have clients reacted to the rebrand, and would you say that the rebrand has been a success?
Absolutely. I mean, I'm not sure if you know, but I just ticked over 10 years working at the same company, formerly Invest Global, now 26 Degrees.
Congrats.
Thanks. Thank you very much. It has, you said it yourself, time has flown by. It's crazy. I feel like it's been 30 years, to be honest, but no, it's been a fantastic journey seeing the company and the whole group evolve over the last 10 and a half years. It was something that I think I mentioned to you in Cyprus that we worked on for quite a few years, and so it did seem like it was perhaps it sort of came out of the blue, the rebrand, but it was something that was considered within the marketing team and the executive team for about 2.5 years. So it was something that was, very well thought out and planned. I will admit, we've been called Invest Global or Invest this week quite a fair bit.
It's understandable.
Yeah, we do expect that to continue for a little while. I mean, there's quite a few other brokers here that have rebranded and people still call them by their former names, but that is what it is. I mean, at the end of the day, it's the people in the company that I think make up the brand, and as well as the technology. But I think as a whole, it's been really successful, and we're very happy.
Yeah, I think operationally, we couldn't have asked for much more. It was executed really, really well over some months. All about branding. It takes a lot of work to roll out something like this. I think in general, having been in Sydney recently, only 6 months ago, and going back there, speaking to the team often. We've also got the team in Cyprus. I think it's we're all quite happy to be working under a brand that it better represents us. So 26 Degrees, it's really an Australian feel about it. Invest, while we're super proud of our Japanese heritage, it is really a Japanese name, and 26 Degrees is an Australian-run company. So I think we're all super proud and happy to be working under a brand that better recognizes us and our background and our identity, I guess.
Yeah, definitely. Awesome. So another time-related question. As we head into the end of the year, I wanted to ask you guys where you see the industry heading in 2024, particularly with respect to prime brokerage and access to credit. With respect to prime brokerage, I think the real question is, are we going to see further consolidation in the prime brokerage space, which has been discussed, I think, extensively this year? And what do you guys think will happen to access to credit? I know I've gotten James Alexander's opinion on that earlier this year.
Yeah, absolutely. I'll jump in. I mean, we'd love to speak about this for an hour, to be honest, because it's something that honestly, I'd love to hear what everyone in this room would say to that question, because from our point of view, what we've seen from the top down, from the tier one bank prime brokers, margin requirements are increasing. NOP capacities are decreasing at times in certain areas due to, the riskiness of the asset classes or the particular instruments that we're focusing on. But it is, I think it's begun to happen for the last 18 months, where true prime primes like ourselves that have tier one bank prime broker relationships are beginning to pass on, or let's say reflect the banking conditions that we're obliged to meet. And it's just a matter of, it's interesting, right? Because I said that there's the subprime primes as well, and then there's so many different segmentations. Everyone, ultimately, the prime brokerage game is one of a balance sheet, where we subsidize, the margin requirements that we have from the tier one prime brokers, and our retail broker clients, they have to understand that those are increasing. And I would love to understand, hear other people's perspectives, because there is a bit of an educational piece when people are perhaps surprised if we focus on gold, which is, the most traded instrument at the moment. The fact that, bank prime broker margin requirements start from, 5% and go up from there. I think that it would be quite a shock for some of the retail brokers to hear that. But it's important. They have to understand that this is a risk game. And there's a lot of money on the line. there have been some recent stories that I'm sure a lot of people are aware of where they've got themselves into trouble by not managing that risk, as carefully as they probably should. So I think what we'll see over the next 12 months is a continuation of what we just said, where, reflecting the top-down prime brokerage conditions.
Yeah. Yeah. Yeah, I think, as you said, you've spoken to James before. I think you've maybe spoken to Gavin as well. We've always been of the opinion that the bank prime brokers, the bank tier one prime brokers, are eventually going to be pulling out of this market due to, capital requirement that doesn't make this business sort of efficient for them. So in the first sense, there's a gap for us to fill, 26 degrees. There's a 26 degrees sized gap somewhere in there to be a non-bank prime broker for all of these clients that need capacity, they need the space. I think in the last few years, especially, like Lochlan was saying about the gold margins, there's a genuine disconnect between what the prime brokers are pricing and their pricing of risk and what the retail market expects. And I think what's probably the first question you asked us has exacerbated that disconnect, because brokers are moving so far towards the B-book model, right? They're internalizing 90% of flow and 95% of positions even. If you're internalizing your positions, you don't need to worry about what the margin requirement is at your prime broker. And if those margin requirements are slowly creeping up, like they have been especially in gold, then that can almost take you by surprise, right? Because you've been B-booking and then all of a sudden the volatility drops. You need to start hedging more. You need to move back to that traditional A-book model. And oh crap, margins are much higher than they were last time I looked. So I think if the low volatility continues, and if the A-book model comes back, the traditional A-book model comes back a bit, then I think that disconnect is going to slowly squeeze. And during that disconnect, that's definitely going to push some players out of the game, I think, and cause a consolidation of the client base and the capacity.
Which, from a risk point of view, maybe not a salesperson point of view, to be honest, it's the same thing. We don't take on any retail broker that exists. We focus on, the right brokers that understand what we're doing on our side, appreciate it, respect it, and make the most of what we give them. I think you're spot on, James. Like, I think I think we both agree that over the next 2 years, probably even 3 years, we'll continue on this trajectory where they are, externalizing or A-booking a little bit more percentage of their total book size, which will mean they will have to appreciate that margin requirements and NOP limits are, very critical to the business, and they have to understand that. Those with smaller balance sheets, or those that aren't willing to put their balance sheet forward, will need to consider doing so. Otherwise, there will be some further consolidation. I mean, just this week, I've heard of some pretty big deals going ahead and happening in the next couple of weeks, which I'm sure you'll report on. I can't share them; it's all confidential. But it's super exciting.
Awesome. Well, gentlemen, thanks for taking the time to speak with us today. Good luck towards the rest of the year. Happy holidays. I think the organizers of this event are actually going to be hosting an event. They're going to, I think, call it the Pacific Summit next year. So I am very much looking forward to that, attending that and seeing you guys on your home turf, and speaking to you there as well. So all the best, and thanks so much for joining us today.
Thank you very much. Cheers.
Thank you, gentlemen.
Cheers. Yeah, looking forward to Sydney, home turf.